Silver just did something it has not done in weeks. It broke through resistance that traders swore would hold. Every metal tracked by the market moved higher today, but silver moved faster than all of them. Now there's a number on the calendar, Wednesday, and what happens that morning could decide whether silver's next move is toward $70 or back down to where it started. The Federal Reserve is watching, Wall Street is watching, and in less than 48 hours, the answer arrives. Stay until the end, because what we uncover about Wednesday changes everything. In this video, you will learn exactly why silver surged today, the precise data point landing this Wednesday that could determine the metal's next major move, why silver may now be positioned to outperform gold in this specific scenario, and the hidden risk factor from overseas that could still reverse everything before the week is out. Welcome to Currency Arc Insight, the channel dedicated to decoding the economic signals that matter before the headlines catch up. If this kind of strategic analysis is valuable to you, consider subscribing so you never miss a warning like this one. Let us know in the comments where you are watching from today. Monday's trading session delivered a signal that market analysts and institutional stackers alike had been anticipating for weeks. A broad, decisive rally across the entire precious metals complex, with silver emerging as the unmistakable leader. Every metal tracked by major exchange data closed higher on the day. Gold advanced a steady 1.12%, settling near $4,390, $80 per ounce, reinforcing its long-held reputation as the more measured, stable performer among the group. Platinum edged upward modestly, gaining roughly $8 to reach $761. Palladium followed a similar pattern, up $5 to $1,402. Even rhodium, a metal that rarely commands headlines, posted a meaningful gain of $75, closing near $9,325. But it was silver that commanded the market's full attention. The metal surged 3.43% on the day, climbing $2.16 to close at $65.86 per ounce, after touching an intraday session high of $66.18. For a single trading day, this is not an incremental move. It is the kind of surge that reorders near-term expectations and forces analysts to revisit their forecasting models. With this advance, the long-discussed $70 threshold, once considered a distant and difficult target, has moved decisively within reach. To understand the significance of this move, context matters. Silver had spent recent weeks locked in a consolidation phase, unable to convincingly break above resistance levels that had held firm since the middle of June. That resistance cracked on the prior Friday, when silver broke through its 50-day moving average, climbing 3.75% to settle at $63.79, clearing the moving average line by a margin of 4.47%. Monday's session confirmed what Friday's move suggested. This was not a temporary spike, but the early stage of a more sustained directional shift. This distinction matters for anyone evaluating silver not as a speculative trade, but as a strategic economic position. Markets frequently produce single-day surges that reverse just as quickly. What separates Monday's rally from noise is the technical structure behind it. A break above a 50-day moving average, followed by a continuation higher, rather than a retracement, is generally read by institutional analysts as a shift in underlying momentum rather than a temporary imbalance. For business leaders and serious investors, the immediate question is not simply how high silver can climb, but what is driving the move and whether that driver is durable. A rally built on speculative momentum alone tends to be fragile. A rally built on structural economic forces, changing interest rate expectations, and shifting global risk sentiment tends to be far more resilient and far more consequential for those positioning ahead of it rather than reacting after the fact. This is where the current environment becomes particularly significant. Silver's breakout did not occur in isolation. It followed a specific and measurable shift in labor market data the previous week, data that altered the market's expectations for Federal Reserve policy in the near term. That shift did not merely nudge silver higher. It reshaped the calculus for the entire precious metals complex, and it set the stage for a critical data release now just days away. Understanding why that labor data mattered, and why the Federal Reserve's next moves are so closely tied to silver's trajectory, requires stepping back from the price chart and examining the economic mechanics beneath it. That is where the next phase of this analysis begins, not with speculation about where silver might go, but with a precise accounting of the data that moved it there, and the deadline now approaching that could determine whether this breakout holds, extends, or reverses. The numbers behind Monday's surge tell only part of the story. The full picture requires understanding what changed last week, and why serious market participants are now watching a single date on the calendar with unusual intensity. To understand why silver moved as decisively as it did on Monday, the analysis must return to the preceding week, when a single piece of economic data reshaped market expectations for the entire precious metals complex. The catalyst was the July labor market report. Non-farm payrolls fell by 23,000, a figure that stood in sharp contrast to what forecasters had projected. This was not simply a miss against expectations. It represented a meaningful deterioration in a labor market that had, until recently, been characterized as resilient. The unemployment rate ticked upward to 4.1%, a modest shift in isolation, but one that gains weight when paired with the broader trend it confirms. Compounding the significance of the headline number was a substantial downward revision to prior month's data, a combined reduction of 103,000 jobs. Revisions of this magnitude are rarely dismissed by serious economic analysts. They suggest that the labor market's underlying strength had been overstated in real time, and that the true trajectory of employment has been softer than previously understood for some time. For business leaders and investors tracking macroeconomic signals, this combination, a weak headline print alongside a significant downward revision, carries more weight than either figure would in isolation. It indicates a pattern rather than a single data anomaly, and patterns are what shift policy expectations. The immediate market consequence was a repricing of Federal Reserve policy expectations. Prior to the report, the probability of a September interest rate hike stood at approximately 2/3, reflecting market confidence that the central bank would continue tightening in response to persistent inflation concerns. Following the report, that probability fell to approximately 44%, a substantial single-week shift. Subsequent trading sessions pushed that probability lower still, with some data points showing the market pricing in odds closer to 44% before narrowing further as the week progressed. This shift in rate expectations is the mechanical link between the labor data and silver's price action. Precious metals, silver and gold in particular, carry no yield of their own. Their relative attractiveness as a store of value rises and falls in direct relation to the opportunity cost of holding them, an opportunity cost that is set largely by prevailing and expected interest rates. When the market reduces its expectation of future rate hikes or begins to anticipate rate cuts, the opportunity cost of holding non-yielding assets like silver and gold declines. Capital that had been allocated toward yield-bearing instruments becomes more inclined to flow toward metals. This dynamic explains why Monday's broad rally across the metals complex followed so closely on the heels of the labor data. It was not a coincidental convergence of unrelated market forces. It was a direct and largely predictable response to a fundamental shift in the interest rate outlook, a shift triggered by evidence that the labor market is weakening more than previously assumed. There's a second dimension to this data that deserves careful attention. A weakening labor market does not, on its own, confirm that inflationary pressure is easing. Employment and inflation are related but distinct variables, and a decline in job growth does not automatically translate into cooler price growth. This distinction is critical because it means that last week's data provided only partial confirmation of the case for looser monetary policy. The labor side of the equation has shifted. The inflation side remains an open question. This is precisely why market participants are not treating Monday's rally as a settled matter. The labor data made a Federal Reserve rate hike more difficult to justify, but it did not resolve the inflation question that remains central to the central bank's mandate. That resolution, or at minimum the next major piece of evidence toward it, arrives in a matter of days in the form of a specific economic report that markets are now treating as a decisive checkpoint. Understanding what that report is, why it carries such weight, and why it has become the single most important date on the calendar for silver's near-term trajectory is the focus of the analysis that follows. If last week's labor market data supplied the first half of the case for a shift in Federal Reserve policy, this Wednesday's Consumer Price Index report is positioned to supply the second, and markets are treating it with corresponding weight. The report is scheduled for release at 8:30 a.m. Eastern Time on Wednesday morning, followed by the Producer Price Index on Thursday and retail sales data on Friday. Of these three releases, the Wednesday CPI figure stands apart as the one most likely to determine the near-term direction of precious metals, and silver in particular. The reasoning behind this rests on a distinction that serious market analysts draw carefully. A weakening labor market makes it more difficult for a central bank to justify raising interest rates, because doing so risks compounding economic softness that is already visible in employment figures. But a weakening labor market does not, by itself, confirm that inflationary pressure has cooled. These are two separate questions, and a central bank operating under a dual mandate must weigh both before shifting policy with confidence. This is the analytical gap that currently defines market positioning. The labor side of the equation has moved. The inflation side has not yet been confirmed. Wednesday's CPI report is the data point capable of closing that gap one way or the other. Should the report show inflation continuing to cool, it would provide the missing confirmation the market has been waiting for. It would strengthen the case that the Federal Reserve can hold rates steady or move toward cuts without reigniting price pressures. Under that scenario, the current rally across silver and the broader metals complex would gain further justification, and the path toward the $70 threshold for silver would become considerably more credible in the eyes of institutional participants. Should the report instead show inflation holding firm or reaccelerating, the calculus shifts considerably. A hotter than expected CPI print would undercut the dovish narrative that has driven metals higher over the past week. It would suggest that despite a softening labor market, price pressures remain embedded in the economy, complicating the case for near-term rate cuts and potentially prompting a reversal in the gains metals have posted in recent sessions. This is why market participants describe Wednesday as a genuine inflection point rather than a routine data release. The current rally in silver was built on labor market weakness alone. It has not yet been tested against the inflation half of the equation. Until that test occurs, the rally remains, in a technical sense, only partially confirmed. There's a further layer of significance specific to silver that deserves attention here. Because silver occupies a dual role as both a monetary metal and an industrial commodity, its reaction to Wednesday's data may diverge meaningfully from gold's. A benign inflation reading that allows the market to price a Federal Reserve policy hold without simultaneously escalating concerns about broader economic weakness would be interpreted differently across the two metals. Gold's primary reaction channel runs through falling yields and a weaker currency. Silver benefits from that same channel, but carries an additional one: improved sentiment toward economic growth and industrial demand. This means that a specific and narrow outcome, softer inflation without an accompanying deterioration in growth expectations, could position silver to outperform gold in the sessions following Wednesday's release. This scenario, and the mechanics behind it, will be examined in detail in the next phase of this analysis. For now, the essential takeaway is this: the market has priced in a significant portion of its current optimism based on incomplete information. Wednesday's CPI report is the data point capable of completing that picture, and depending on its outcome, it holds the capacity to either validate the current breakout or expose it as premature. Serious market participants are not treating this as background noise. They are treating it as a deadline, one with direct consequences for positioning, and one that leaves little room for complacency in the days immediately ahead. To understand why silver could outperform gold in the days following Wednesday's report, it is necessary to examine the fundamental difference between the two metals. Gold functions almost exclusively as a monetary asset, a store of value whose price movements are driven primarily by real interest rates, currency strength, and safe haven demand. Silver shares those same monetary characteristics, but carries an additional dimension: substantial industrial application across electronics, solar technology, and a range of manufacturing processes. This dual identity means silver's price is influenced by two distinct forces that do not always move in tandem. When yields fall and the dollar weakens, both gold and silver benefit through the same mechanism, a reduced opportunity cost of holding non-yielding assets. But silver has a second lever that gold lacks: a strengthening outlook for industrial demand and broader economic activity. This distinction becomes critical when considering the range of outcomes Wednesday's inflation report could produce. Should the data confirm cooling inflation without simultaneously signaling a deteriorating growth picture, markets would likely interpret this as movement toward what analysts describe as a disinflationary soft landing, a scenario in which inflation eases without triggering a broader economic downturn. Under that specific outcome, gold would respond primarily through the traditional channel of falling yields and reduced tightening risk. Silver would respond through that same channel, but with an added tailwind. Improved confidence in economic stability tends to support industrial demand expectations, and by extension, silver's non-monetary demand base. In this scenario, silver is positioned to advance on two fronts simultaneously, while gold advances on one. This helps explain a pattern that recurs across market cycles. Silver often exhibits greater price volatility than gold in both directions, advancing further during periods of monetary easing paired with economic stability, and underperforming during periods where growth concerns dominate even as rates fall. The inverse scenario carries equal weight. Should Wednesday's data reveal cooling inflation alongside clear signs of economic weakness, the growth-sensitive component of silver's demand profile would work against it rather than for it. In that environment, gold's more singular reliance on the monetary channel could allow it to outperform, as investors seek safety without the complicating exposure to industrial cyclicality that silver carries. This is the analytical distinction that separates informed positioning from simple directional speculation. The question is not merely whether metals rise or fall in response to Wednesday's report. It is which specific combination of inflation and growth signals emerges, and how that combination interacts with the structural differences between a purely monetary asset and one that straddles both monetary and industrial demand. For serious market participants, this framework matters considerably more than headline price targets. Understanding why silver moves the way it does, not just that it moves, is what separates strategic positioning from reactive speculation. The metal's dual nature is not a minor technical footnote. It is the central mechanism that will likely determine whether silver's current breakout extends meaningfully beyond gold's or converges back toward it, once Wednesday's data is fully absorbed by the market. Every analysis built on a bullish thesis carries an obligation to examine what could invalidate it. And in the current environment, that risk exists outside the domain of interest rates and inflation data entirely. It resides in global oil markets, and specifically in the geopolitical tensions surrounding critical shipping routes in the Middle East. Oil prices have moved sharply higher in recent sessions, climbing more than 6% on renewed uncertainty around a key waterway that handles a substantial share of global oil and shipping traffic. Negotiations aimed at easing those tensions have stalled, with conditions demanded before normal operations can resume. Attacks on refining infrastructure in the region, combined with continued disruptions affecting Russian energy facilities, have added further upward pressure on energy prices. This matters for precious metals in a way that is frequently overlooked by less disciplined analysis. The relationship between oil and silver is not fixed. At times, the two move together, as they did on Monday, when broad risk sentiment and inflation expectations pushed both higher in tandem. But this correlation is the exception rather than the structural rule, and it can reverse without warning. Should tensions escalate further, particularly if shipping lanes face direct disruption or facilities central to regional energy infrastructure sustain significant damage, oil prices could climb considerably higher. In that scenario, rising energy costs would feed directly into inflation expectations, undermining the very case for Federal Reserve rate cuts that has supported this week's rally in metals. A market forced to price in renewed inflationary pressure from energy costs, even alongside a weakening labor market, faces a considerably more complicated policy outlook, one that could just as easily strengthen the dollar and pressure silver lower as it could support further gains. This is the essential tension serious market participants must hold in mind heading into Wednesday. The current rally rests on a specific and narrow interpretation of recent data, a softening labor market interpreted as a clear path toward looser monetary policy. That interpretation could be complicated or entirely reversed by developments entirely outside the scope of Wednesday's inflation report. For business leaders and investors evaluating this environment, the appropriate response is not to abandon conviction in silver's longer-term fundamentals, nor is it to chase short-term price action based on a single favorable data point. It is to maintain positioning discipline, a core allocation built with the understanding that near-term volatility is not only possible but likely, is a materially different strategy than a speculative position built entirely on the assumption that Wednesday's data confirms the bullish case without complication. This distinction between disciplined conviction and reactive speculation is the strategic takeaway this analysis is built to deliver. Silver's breakout is real. The data behind it is meaningful, but the path forward is not guaranteed. And multiple forces, some scheduled and measurable, others geopolitical and unpredictable, remain capable of reshaping the outcome in either direction. Serious positioning accounts for both possibilities. It does not require certainty about which outcome prevails. It requires preparation for either one, and a strategic framework built to withstand whichever direction the coming days ultimately reveal.